Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, September 24th, 2014. In this video, I wanted to talk about the SPY, the S&P 500, really focus on the U.S. equity markets. This won't be a broad market coverage. I may touch on a few of the other key U.S. indices towards the end of this video, but right now I wanted to focus mainly on this 60-minute chart on the SPY and the pattern, this broadening wedge or broadening top formation pattern that's formed. I mentioned that in a static post this morning. That's on the site. You can take a look at it. But let's go ahead and just quickly analyze what's happened here in the SPY recently. This white downtrend line here, this was pointed out a few days ago as a bull flag pattern. We had this bull flag pattern on the SPY, and that a bull flag pattern that started from this move here. If you recall, we had the second target on the SPY, the downside target. This goes back. Let me back up a minute, folks. Here's the 2-hour. This is a 2-hour chart, same one that I posted this morning. And this is a rising wedge that we shorted the breakdown on, and my second target was hit back in, looks like early August. I had two downside targets on the SPY. Those were hit, and we had a nice reversal. At the time, it was pointed out there was negative divergence beneath this rising wedge. That's what, it's one thing to short a breakdown of a pretty well-defined trend line or rising wedge pattern, but what I usually look for are divergences to confirm that pattern, confirm a trend change in the near future is likely, and that's what we had here. So sharp drop off. It was a nice trade on the short side. We bounced as expected. I wasn't expecting the bounce to go this high, but with that being said, that's what has happened here. I did point out at the bottom, though, we had the positive divergence. Again, when you see positive divergence on a 60-minute time frame, you're looking at a bounce that's usually going to last more than just a few minutes or a few days, and that's what's happened here. So we bounced pretty strong off the early August lows, and that was the flagpole, if you will, of the pattern. And then let's just get back to the 60-minute time frame. On the 60-minute time frame, here's our flagpole. Just disregard these blue lines for a minute. This was the bull flag, and we had a breakout. As I pointed out before the pattern broke out, my expectation would be that any breakout would be sold into, would fail, and that is what happened. The breakout lasted for just a couple days, and if you look here, you can see there's been some very impulsive selling. So that is bearish. Let's say the bear signal number one. This is why right now I'm watching this ascending broadening wedge pattern along with other things on the longer term charts. But in the 60-minute charts, this is what I'm watching. And, these patterns, any type of wedge or consolidation pattern, whether it's a traditional wedge, a triangle, or a broadening wedge, megaphone pattern like this, they can break either way. They can break to the upside, they can break to the downside. But being that we've had this recent failed bullish breakout, and anytime you have a failed breakout, whether bullish or bearish, you tend to see a pretty violent and quick reaction in the other direction. So on a bullish failed pattern, that's what we've seen here, and my expectation is for more downside because of that, because the fact this bull flag pattern had failed. If you take a bull flag, you take the length of the flagpole leading up to the pattern, and then you add that to the bottom of the flag. And so this pattern would have projected way up into the, I have to do the math on it, but probably north of somewhere around 210 or so, just under that. And we didn't even make it to 202, it looks like. So that's what's happened. Now we also have negative divergence, as mentioned. Very clear and pretty powerful negative divergence here on the 60-minute chart. This divergence goes all the way back to mid August. We look at prices making a higher high, as shown by this upper trend line, and the RSI, MACD, and I'm sure some other indicators and oscillators making lower highs. So negative divergence, failed breakout. That puts me on guard for a downside break of this pattern. So if I were not sure which way this pattern was going to break, if I didn't have any, if I couldn't make heads or tails based on the price and momentum indicators, the daily charts and the weekly charts weren't clear to me or were pointing bullish, I would not attempt to short or position short within this pattern. But with that being said, the charts are stacked right now, meaning from everywhere from the 60-minute all the way out, daily, weekly charts. We have powerful negative divergences in place. Prices are just hovering above key, multi-year uptrend line support on the SPY, on the NASDAQ 100, the NASDAQ Composite, et cetera, et cetera. We've already had the small caps and mid caps break those key support lines. So I am looking to position very aggressively short. I'm looking to position for swing shorts, meaning multi-week, possibly multi-month short trades. Now, some of my position may be covered if this pattern does play out. I may cover that just as a quick trade, but I do plan to use this as an entry point for some longer-term swing shorts here. Now let's talk a little bit about my trading plan. The ascending or the broadening top formation pattern, there's something referred to as a partial rise. And a partial rise is when you have that last tag on a fully formed pattern, which, by the way, this is from my experience in trading these patterns and looking at the definition of the patterns, you need at least 2 touches, if not several. We have a group of 2 here. We'll call those multiple tags, the second cluster or the second uppermost tag, 3 tags. And we have several tags on the bottom, including the one that we had at the close yesterday, open today. So this is a fully formed ascending broadening top pattern, and now what I'll be looking for is to position on a partial rise. Partial rise, let's take a look at that. Okay, this is we're on the patternsite.com. Let's try to straighten this out here. Okay, patternsite.com. This is Thomas Pulkowski's site. He has written many books and studied various technical patterns. Most of you are probably familiar with him. Check out the site. It's a great resource for trading. He talks about the partial rise pattern here. This looks just like that SPY ascending broadening top pattern we just looked at. And a partial rise, I'll just breeze through these. The first characteristic, you need to make sure it's an established pattern and it meets the criteria, which it does. This SPY pattern definitely meets the criteria of a broadening top, aka megaphone pattern. We've had the touches on the bottom trend line. Now, what we're talking about here is how to trade this. Now, typically, you'll see a bounce off that final tag. And it's common, although it can stop anywhere within the pattern, it's very common to see it go as high as a 50 to even the 61.8 Fibonacci retracement. Those are common reversal points. As mentioned down here, let me scroll down a bit. See a trend reversal at the 50 or 62. That's the 61.8 Fibonacci retracement of the prior move. May signal a partial rise. So my strategy here is to put to short the pattern. Now you can short, let's just get back onto the chart. You can short anywhere here now. We're already at, I had some Fibonacci's drawn here. Okay, I've put up the retracements here that I had drawn. So this is the move from the top down, and these are the Fibonacci retracements. So we look over here. If you follow to the left of the screen, I know it might be hard to make out, but this first dash line, and again, they're not very bright on this chart, but there is a dash line here that's a 38.2 retracement. This is a 50% retracement. In other words, halfway down from the top, the recent highs, down to the lows. That would be a 50% retracement. And here's the 61.8. So we're already at that 38.2, which is a very common reversal place for counter trend bounces, if that's what this is. So by all means, one could put on a short here. We're watching as I speak. The SPY is at 198.79 as we're doing this. This is a live chart. So this is certainly an area to either establish a full or a partial short position, scaling in all the way up into that 61.8 fib, comes in with some really nice horizontal resistance. If you look at the crosshairs, there's a big gap right here from the other day, and if we go back, there's a reaction high. So this looks like a pretty decent, call it the 200 to 250-ish area. Looks like very nice horizontal resistance. On top of that, the 61.8 fib is just below that. So my plan personally now, although will be taking individual shorts. I already own quite a few. I've been scaling in pretty aggressively over the last few days and continue to add. I may take some index shorts or other plays on the SPY or Qs here. And if so, my plan would be to scale in up until that point with a stop. Let's just say I'm taking a SPY short. It will be, I will scale in, adding to no more than above the 200 level, and my stop would be set somewhat above the top of that gap. Top of that gap is 2065. Now, if you look at that, that is about, call it we're at 199 and the stop is just above 200. We're talking just over half of 1%. So even if you were more liberal, you could give yourself a 1% stop. 1% on 200, that's 2 points. So 2 points above 199, that's 201. You're talking a 1% stop. You're risking 1% on the downside for tremendous potential on the downside, especially if this morphs into a longer-term swing trade, which I think we have the potential here. So, of course, first things first, this trade may not play out. If prices do go much higher than that 201 level, they're probably going to go to the top of the wedge. If they go to the top of the wedge, that means the SPY has made a new high. You're going to see some buying come in, some shorts cover, and then we could break to the upside of that wedge. So again, like any trade, this may or may not play out, but the risk reward, in my opinion, is very attractive on this. You're looking at about a 1% downside to trade it as you want. You could have a pullback. I think if this wedge were to break to the downside, the very least you're looking at is a move down to probably this 194 area, quite likely a revisit of the recent lows down around 190-ish. So you have a lot of downside there for a short-term trade. However, if we do revisit these lows and this pattern does break to the downside, the charts are what I refer to as stacked right now, meaning when I look at the short-term time frames, we're looking at a 60-minute intraday time frame here. I look at the daily time frames all the way out to the weekly time frames. We have the SPY, all the major large-cap U.S. indices, the S&P 500, the NASDAQ, composite NASDAQ 100 are all close to or just right above very important uptrend lines. Some of these are multi-year, even their bull market, entire bull market uptrend lines off the 2009 lows we're not far from. The small caps and mid caps, as I've recently pointed out, have already broken down below their bull market uptrend lines off the March 2009 lows. And if they manage to close below those trend lines, make a solid close by the end of this week, that will be a pretty good sell signal. So, in other words, by this relatively small pattern breaking out, it has the potential to send prices down and take out support on the weekly and daily time frames, in which case we would see a lot more than a quick trade of them, maybe good for 3, 4, 5% here. So again, for a 1% downside, I think that's an excellent opportunity. So again, that's my plan here. Negative divergence, recently failed pattern on the 60-minute, and I talked a little bit about the partial rise pattern, and that's what we're looking for here. It's a partial rise, put a short on, and then go from there. Just a quick FYI, going back to the patternsite.com, these are the statistics on broadening patterns. Partial rise, shorting, in other words, shorting or expecting a breakdown on a broadening top pattern. It has a 61% success rate. Keep in mind, I'm pretty sure that Bukowski did these numbers before the previous bear market, in which case we'd probably have even greater numbers. We had a lot of these studies, a lot of the, you pick up the textbooks on charting and patterns and success and failure rates. A lot of those were done, into the 90s and early 2000s when we had, coming off one of the longest bull markets, the most powerful in strength and duration in a long time. So we had, of course, bear market from 2000, 2002. But the Great Bear Market, I don't believe any of these success rates, any of these statistics have been updated. So just keep that in mind. But either way, in trading, even all you're looking for is better than 50-50. As I said earlier, if this broadening top pattern didn't have the divergences in place and other things that led me to believe that, or to expect a downside break, I wouldn't be trading it. Otherwise, it's just a crapshoot, 50-50. Prices are either going to go up or they're going to go down. Now, even with 50-50, with proper money management, you can make money trading. If you're using, my golden rule is use at least a 3-to-1 risk-reward ratio on a trade. So if half the time you're stopped out, you lose 1%. The other half the time you hit your profit targets, you make 3%. Well, overall you're making money. So that's the key to trading. But when you can put the odds in your favor, trade these patterns, look for these success rates, above 60, percent. That helps put the wind at your back. Now, textbooks are great. All these studies, statistics, and all that. But let's look at a real world example of this, shorting a partial rise into an ascending broadening top pattern. This is some of you might recall. For those of you that have been following the site for a while, I was very bearish on gold. In fact, gold was one of the longest standing shorts on the site. The miners in gold stocks in the last few years have probably put more money, or undoubtedly put more money in my pocket than any other sector out there. I've had some great individual stock trades, but as far as sectors go, I was able to, on the site, short the bulk of gold and the gold mining stocks on the way down. If you've just started following the site in the last year or so, you probably think I was a gold bug, and this is a gold bug site, and that couldn't be farther from the truth. Again, just study. That's why I have the archives up there on the front page. There's a calendar. There's a search function. You can check every post that's ever been made on the site, win or lose. They're all there. This is February 14th, 2012. At that point in time, I was highlighting the same pattern, and let's take a look at it. Let's take a look at what I said there at this time. I wanted to share this. It's a GDX 2-day chart. I mentioned shorting Nugget in the miners back on February 6th, as gold and gold stocks were currently among my favorite swing shorts. I'd also mentioned a few weeks earlier I was eyeing a potentially bearish pattern in GDX, but I wanted to wait for some early signs of confirmation, and that's really what we have near. Same thing on the SPY. And it goes on. You can read the post. Talk about the partial rise pattern and everything I just talked about today, where you go ahead. We had the fully mature ascending broadening top pattern. We had a bounce. I was looking to short that partial rise with a stop just above where prices turned down, and that's exactly what we did. And here's a chart. This is going back to, let's see if I can zoom it a little bit here. Okay. There's time-stamped. All the charts on the site are always I'm sorry, I can't speak. Time-stamped. This is February 14th, Valentine's Day, 2012, and there's the partial rise I was referring to. What I waited for, as stated in that post, I wanted to see confirmation, because remember, on a partial rise, if you want to get very aggressive, you can start shorting at that 38 fib, like I just talked about on the SPY. You can wait till you get to the 50, the 61.8. If we go much beyond there, be careful, because it's probably going to be more than that. However, if you like confirmation, you don't like getting in front of trades too early, you wait to see the reversal, which is exactly what it did here. If you take a look, when I made that post, we'd already had turned down pretty impulsively. You can see a few days of selling after the partial rise, and that's when I mentioned, the all clear to go ahead and short. And GDX, if you look here at the time, was 53.72. Let's take a look at GDX today. 22. So well below 50% drop in GDX since that point in time. Let's take a look at the weekly chart. Here's my weekly chart. This is the same chart I've showed before. Here's that broadening wedge top pattern. There's the partial rise I just pointed out. We were looking at the 2-day chart back from 2012, 2-day period, meaning every candlestick was a 2-day, represented 2 days price action. There's the partial rise, and as I stated, your plan, once we turned down, that was where the short entry was. And if you look close enough, I don't know if you can make it out on the video, prices came back to challenge that level, but never took it out. They failed right there on the second attempt where that partial rise started. So we came down and never looked back. We had a retracement here, but it didn't even come close to the taking out the the partial rise where that short entry was. So there's a real world example of how that pattern worked. These things do work. They don't work every time, but with proper money management, you short there once you get confirmation with your stop not too far above, and you really can't find a much better risk reward situation out there in trading. There very few exist than this partial rise pattern. That's probably why I'm talking so long on this thing. So if it doesn't work out 2 days from now, stop out. That's it. Move on. And next time I spot the next one, we just do it again. And you do that enough, and you're putting the odds in your favor. Just an FYI, here's GDX. I had pointed out before this inverse head and shoulders pattern formation, or potential inverse head and shoulders pattern formation on the minors. It may still be in play. Again, I'm not adding, nor have I added for a while now to my long-term positions. I did take a pot shot at a short-term trade, and I still hold quite a few minors, my long-term positions, but I'm not adding until I see signs of reversal. But I did want to say there is a possibility that this inverse head and shoulders is still intact with a second right shoulder. It's not uncommon to see double-shouldered head and shoulders or inverse head and shoulders pattern. Usually they're symmetrical, meaning you'll have two shoulders on each side if it is a double or complex head and shoulders pattern. But I have seen, and if you look it up in the books, you will see there is, in some instances, you can get two shoulders. So just a possibility. Nothing I'm hanging high hopes on. I do remain longer term bullish, especially with these positive divergence, bullish divergences put in at the lows. But again, this post isn't about GDX, so let me move on. Okay, before we wrap up, as I said, the whole point of that video, I really went off on a tangent on GDX, is to really talk on the SPY and the S&P 500. These charts, again, are all available on the live charts page. There are also links available on the front page. Let's scroll up here. Let me adjust this chart here a little bit. This is my S&P 500 SPX daily chart. And as mentioned, let me make sure, it's hard to tell if I have it centered in here. Most importantly, I'm looking at the fact prices are right on this multi-year uptrend line. This one drawn on the daily time frame goes back to October 2011, those lows, and we're sitting right on that trend line. I mean, literally, negative divergences across the board. Take a look at one more time frame. Okay, this is the S&P 500 on a weekly time frame. This shows the entire bull market from the 2009 lows. Nice uptrend line here, multiple tags. We're a little bit above that. That the one I was just showing you on the daily chart, I had drawn off this reaction low here in October of 2011. But this is the bull market uptrend line, so I actually clipped through that. That gives us a little room. So my point is, again, when I say the charts are stacked, if that 60-minute pattern plays out, and brings prices down much more. As I said, we're only a really bad day or two away, meaning one of those big bad 3% down days plus in the market. It will only take a couple of those to smash through this uptrend line. And being that it is a long-term, multi-year, this is the entire bull market uptrend line. Viewing it here on a weekly time frame, my preference is to wait for a weekly close. I've pointed out these, intra-week breaks when you see these candlestick tails, the shadows that break below and close back up. Those are fake out moves. Those are traders that jump the gun. So if you're a trend trader, once we get a solid close below this trend line, then I would really be concerned about, adding any new short exposure, any new long exposure. Again, I've pointed out the divergences, et cetera, et cetera, et cetera. We'll look at the cues here. This is the NASDAQ composite. We had this channel here, nice channel, parallel ascending channel. Prices broke down and have been crawling up under a perfectly parallel, what I call sub-channel. So, we had the true breakdown here. And I'll admit, this is when I thought we were going to get some real selling. I had these targets. We did hit my first target back then, fell shy of the second one. I maintained these targets. I think this is just an extension. Yes, we went on to make a marginal new high, but if you look at these divergences and go back, study these charts, look at the divergences, and I I urge you to try to find a case where you saw multi-month divergences on both the RSI, the MACD, with a rising wedge pattern or a well-defined uptrend line, and didn't see a substantial correction when those trend lines broke down. So even this correction, was substantial. That was good for a nice trade from the highs when the divergences were put in. I didn't draw it; they were actually extended to right here. There'd be a little bit of a steeper downtrend line there. It's drawn all the way to this point. So we did have a nice correction, and we've had the market's pushed up to a marginal new high, but once again, nice divergences in place. So my expectations for a break below that, once we take out that support level, that'll open up the door to move back down to that former T1 target that's already been hit. That'll be the next support level, and ultimately I expect a move down here lower. Okay, this has been Randy Finney with Right Side of the Chart.